started. So thanks everybody for joining our home buying webinar. My name is Carla Giacomini. I'm marketing here at Alterna, and I'll be hosting the webinar today along with Nathalie Desjardins, and I'll give her a nice introduction. But before we go through that, I wanted to just go through some housekeeping things with you. So first of all, you're going to be in listen-only mode. However, you can put any of your questions into the Q&A on the bottom of your screen. So please feel free to put your questions in there. Normally, more general questions work best. If you have really a specific situation, we can certainly, get in touch with you and work through that. So just keep that in mind. And you can either email alterna.ca/email with your personal questions about your situation, or you can give us a call at 1-877-560-0100. So the other thing I wanted to let you know is the webinar is being recorded. So if you have to drop off anytime, you'll be able to, see the rest of the webinar through the recording. And I'll give you some details at the end of, we'll send those to you. Okay. Just another note that the recording is actually also going to be on our website at alterna.ca, but I'll recap that at the end of the session. So I would like to introduce our guest speaker. So Nathalie Desjardins, thanks for joining. Nathalie is a certified financial planner, and she's one of our branch managers. And she's been with Alterna over 30 years, which is amazing. So her passion lies in empowering our members to achieve their financial goals through education, guidance, and personalized support. So, she's very passionate about and believes in financial literacy, that it's a powerful tool, and loves sharing her knowledge with our members. So welcome, Nathalie, and thank you so much for joining us.
Thanks, Carla.
Yeah. So I'm just going to go through a quick poll with you. So we did want to get some of your input. We will be showing a poll on the screen. It's anonymous, so please feel free to, answer truthfully and honestly. We have no idea who you are and what you're answering. So the poll, this is the poll that does the best describes me. This is kind of the situation that best describes me. So are you a first-time home buyer? Are you looking at upgrading to a larger home, or maybe a different area, right? Are you a retiree, right? Kids have gone, you're an empty nester, now what, right? Do you need this big home? Maybe you want to get into a smaller place, right? Or, you're maybe looking for a vacation home or a property rental, right? Do you want to help your grandkids, your kids or your grandkids with their down payments? As we know, housing affordability is kind of an issue these days. So is that something that's in your future? So answer as truthfully as possible, and we'll actually show I think you can actually show the on the screen. Thank you, Ian, for showing the results. So as you can see, most people are first-time home buyers, or 64%. However, there are some that are looking to help their children and grandchildren, which is great. They do need your support in getting into the home buyers market. And there's a few others that are looking to either switch and go into a different area, or that are empty nesters, are looking for a vacation or rental. So thank you so much for participating in that. And we're going to go on to the topics that we're going to discuss today. So first and foremost, we're going to talk about, Natalie's going to talk about a little bit of a market update, right? What's going on in the home buying market. Things do change. There's all sorts of things, as you can see, that are happening. We know gas prices are going up. So how is this impacting things, and how is it, how may it impact? So we'll give you a little glimpse into that. Also the home buying process. So, what do you need to do? And Natalie take us through step by step on the home buying process. In addition, we have some tools to help you out, right? So a lot of research is important, right? And those tools can help you, clarify in your mind some of the decisions. So we want to support you with those tools, and we'll give you some of those tools as we go along. So I'm going to hand it over to Natalie now, and she's going to be talking about, so giving us a glimpse of what's happening in that housing market. Over to you, Natalie.
Thanks, Carla. So the first indication is home prices have decreased by 5.2%, and that's in February on a year-over-year basis, but with a 1% increase in Ottawa. So if some of you are in Ottawa, there's been a slight increase to about 641,000 and a 7.1% drop in GTA for an average of $1,008,000. So drastically different between the two cities. So
That's quite heavy, right? 1.8
yeah,
million to like that's a big number for the GTA crowd, right? To get into
yeah.
the home buying market for sure.
And so where do you want to live, right? And
Right.
it depends on your job as well. Where do you work and where can you live are two big questions. The average single family home in the province sold for 829,000 in February this year. Um, Let me see here. So Ontario condos, if you look at there was a decrease by 5.3% year over year in February. Ottawa prices decreased by 4.8% to 385,550, and GTA decreased by 2.6%. We're just talking about Ontario condos. So the average price for condos in GTA is 626,550. So again, as you can see, there are differences between Ottawa and GTA.
And yeah,
And
just so like I'm in the GTA, Natalie, and there is a glut of condos available here.
are there?
Absolutely. Yes,
Yeah.
for sure. And it's been like this at least for years. So the prices are going down. So if someone is looking to get into the condo market, this might be a good time to do that for sure.
Yeah, yeah. Good call on that. On March 18th, the Bank of Canada held its key interest rate to 2.25%. So banks held to 4.45% prime rate. So when you hear the Bank of Canada announce rates, it doesn't necessarily translate to the bank prime rate. So bank prime is 4.45. It has not changed. And when you apply for a loan with a variable interest rate, your lender will give you an annual interest rate that's tied to the bank prime, not Bank of Canada prime. So as the rate moves up or down, so does the rate of interest you pay on your variable loan. So the next Bank of Canada rate announcement is April 29th, and we'll see if they make any changes from that point on. And then, as you can see, 30% are gifted down payments in 2024 Canada-wide. So a lot of people that are buying homes are being gifted some of their down payment, if not all of it. And that goes to the price of houses, like we just mentioned, to make it more feasible for people to be able to enter the housing market.
Yeah, absolutely. You kind of need a helping hand, right, on that down payment for sure to get into the market for sure.
Yeah, it's not like 20 years ago.
Right. Absolutely.
Yeah.
Absolutely.
So the housing market update, the Ontario housing market will be influenced by slow growth, with buyers being cautious due to international trade tensions. As we know in the news, we hear a lot of that. There's a softening labor market, so the number of jobs available is smaller. I looked up the unemployment rate. It's 6.7% right now. And so that's going to affect who can afford what kind of jobs they can get, and the affordability issues to buy that home that they want. The other one is I'm just going to check. Yeah. So for the first inventory abundance, mm, there's fewer sellers entering the market in February compared to January. Nice weather should spur activity in the coming months, but the uncertain economic environment with Middle East war, it's forcing gasoline prices and up, and tariffs have people concerned. So some people do a wait and see, but if you're in the market to buy a home, you'll never know when the right time is to enter the market. So that's why I always ask people, why don't you just sit with somebody, sit with an advisor, figure out, where you are and where you want to be and how feasible it is for you right now versus maybe in 6 months, 12 months. Canada's inflation rate is expected to remain around 2.5%. But with these economic changes that we're seeing this last quarter, that might change. That's like anything. Right now, we know what's happening now, but we don't know what's going to happen in the next few months or the rest of the year for that matter. And the last part, this is good news for first time home buyers, is legislation was passed on March 12th to remove the GST, that's 5% on new home purchases for first time home buyers for homes valued up to 1 million. And so with a partial rebate for homes from 1 million to 1.5, those are for those Toronto houses, right, that cost maybe over 1 million. It does aim to increase affordability by saving buyers almost up to $50,000. So that's quite a bit of money. This policy also reduces upfront closing costs and lowers monthly mortgage payments by approximately $240. So it's intended to help young families enter the market, and hopefully it does exactly that.
Yeah, that's great. That was a great thing to get to try to curb that affordability so more people can get into the housing market. Okay.
Yeah, it's so tough.
Yep. Tell us a little about the historical mortgage rates. We have this graph up here just to kind of frame, right, Natalie? You've
Yeah.
seen the rates, go up and down. So
Yeah, I find throughout my career at Alterna, when I was advising members on their mortgage approvals, a lot of people like a 5-year fixed rate mortgage because it gives them a sense of, knowing what their rate's going to be, what their payment's going to be. They don't have to worry about it. They don't have to watch anything. But the 5-year mortgage rate is the most popular rate in Canada. It accounts for nearly 50% of all outstanding mortgages, according to Statistics Canada. Mortgage rates have a big impact on the cost of home ownership in Canada. And this has an effect on Canadian home prices and the economy as a whole. There has been an overall downward trend on mortgage rates with fluctuation periods of increases and decreases. The mortgage rates dropping to historical lows during COVID pandemic. As you can see there, the line right after 2020, I mean, and somewhat leveling off in 2026. And some of my members say, I'm going to wait till rates go really low. And I said, well, you'd have to almost wait for another pandemic. So let's not wait for that. Let's just, deal with the rates that we have now, because we're not going to see those ultra low rates. And that goes for people who have their mortgages maturing as well. They're still reasonable. So we're in a good spot right now so far. All right, cost of home ownership. The rule of thumb is you should have about 1.5% of your home purchase price. So let's go by $100,000 tranches. It's $1,500 for every 100,000. And that pays for multiple things. It could be an appraisal for the home that you want to buy, registering the mortgage on the property title. Obviously, you need the down payment minimum is 5%. So this 1.5% closing cost is separate from the down payment. There's also the land transfer tax. A lot of people don't realize that when they come and discuss things with their lawyer is saying, well, you have to pay this land transfer tax as well. The buyer does, obviously. The mortgage insurance premiums, they're added to the mortgage, but there's tax on that premium. So that's part of the closing costs as well. Legal fees and disbursements. So your lawyer will have a set amount of, like, depending on what you're doing, they'll charge you a fees for that work that they're doing, and the home inspection fee. But there's also moving costs. Um, and I have my notes here. I'm just going to double check. The other thing I was wanted to mention is sometimes when you buy the home mid-year, and the seller has already prepaid the property taxes for the year, you actually have to pay them back that money for a portion of the year that you're going to live in that home. So that's again part of that 1.5% closing cost. It's not something you have to show right away when you get a pre-approval, but you have to show that you have saved that money before closing the purchase of that home you're buying.
Yeah, that's a great pointer. A lot of little details, right, Natalie? For sure.
Yeah, things that you don't think
You'll
of
think
until
of.
you actually sit across from an advisor, and then they'll walk you through amounts and get really specific for you because every situation's different. Um, the other thing wanted to mention that I advise my members is if you're thinking of buying a home, you can do an exercise and calculate what your total monthly cost would be, your mortgage, property taxes, property insurance, like the ongoing cost there on the slide. Figure out how much per month you should have to maintain owning a home and pretend that you're doing it for the next 6 to 12 months so that you get used to this cost before you enter into a home buying contract and move into the home. That way, it'll give you a sense of where your money is going to go and how much is left over. So you feel confident that you can enter into the housing market.
A great idea, actually. Yep. Okay. Going to move on to this. Are you ready? Are you ready for home ownership?
Yeah, that's the big question. But there's a lot of things that if you do prepare, you'll be fine. And again, always with an advisor. Trust an advisor to walk you through this. Um, so the first thing is, do you know how much you can afford? So determine how much you can afford. You estimate your mortgage by factoring items such as your income. If you have existing debts, the utilities, like maybe it's electric heating versus gas, and other mortgage related expenses. Even for the maintenance, you should set aside some money for savings to maintain the home you're going to be buying because things break. Right? You might need a new roof, you might need a furnace. And that's where home inspections will help you when you're actually looking for a home. It's really important to get that home inspection because it'll prepare you for those maintenance costs that you need to save to set aside. Because this is an investment. It might be where you live, but it's also an investment that you have to maintain the value of. Um, the other thing
Ongoing, right, Natalie? Ongoing. Yeah,
ongoing, yeah,
yeah.
because these homes are sometimes forever homes, or maybe they're
Mm.
homes that you're just going to be there for 5, 10 years. And when you want to sell, you want to get the best value when you sell that home. So it's up to each of us that own a home to make sure it's maintained and in good order. Also remember to factor in ongoing household costs like groceries, childcare, mobile phone, internet, clothing, entertainment, all that doesn't stop. So you have to put that all into your budget and figure out, okay, this is feasible. This I can do, right? For number two, have you saved enough for your down payment? Um, so you need at least 5%, but conventional mortgages require a down payment of 20% of the purchase price. With mortgage insurance products, this is the 5% mortgage insurance products. You can buy with as little as 5% down, depending on the home price. We'll get into that a little bit in more detail in the next slide. And then for number three, do you have a regular income source? For that, I would for income sources, if you're on, let's say, a contract, it's really hard to say I'm going to be in that job for a long time. So those are iffy kind of income sources. However, if you've been doing it for more than 2 years and you can show it on your income tax return for the last 2 years, then that could be a way to show your income. But is your income salaried or hourly? All these details the lender will want to know, how you're paid and if it's consistent, so that you have a better chance of getting approved for that mortgage. Number four, do you have a credit history? Well, lenders look at credit history to determine if someone is a reliable borrower. So if you have a blemished credit history, it's something you probably want to work with an advisor with to see how you can improve that. Um, if you don't have a credit card, establish a good credit by acquiring a credit card. Use it for small purchases and pay off the full balance each month. So that way it starts your credit history. So the sooner you do that, the better, because the longer you have a credit card or line of credit for, the better your score becomes. And we'll talk about that in another slide as well. Number five, do you have a healthy credit score? So I talked a bit about blemish credit ratings. So poor credit makes it harder to get a mortgage approval, because obviously if you can't pay certain things for other things, how is a lender going to know that you can also afford that mortgage that they're going to extend to you? The other thing is always meet your monthly minimum payments on time, even if it's the minimum payment, right? You might want to pay it all off or pay a big amount, but you have to look at your overall budget, and don't stop there. Be aggressive about clearing your credit card debt, or at least bring each credit card balance to under 35% of its credit limit. So if you have a credit limit of 10,000, leave it a balance of 3,500 or less. That's a good ratio of debt to limit. If you're recovering from bankruptcy, apply for a secured card to help reestablish a pattern of responsible borrowing. And for number six, it says, have you got a handle on your debt? Yeah, so a high debt load could hinder your ability to meet your financial obligations. If you have too many payments for other debt, you probably would have a hard time getting approved for any more debt. And a mortgage is your biggest loan you'll ever get in your lifetime. So again, an advisor could say, okay, let's work on your debt. Maybe you want to consolidate it, make it more manageable, or lower your interest payments so you can pay it off faster. Or maybe there's a strategy we can show you to start on one and then cascade it to all the other debt that you might have over time. And I'm just going to look at my notes here. So your monthly debt repayment should not exceed 40% of your household gross monthly income. That's a mouthful.
Yeah, say it again. Yeah, slowly, Natalie.
Exactly. I'm going to say it again. So, your monthly debt repayments, housing, car, credit cards, lines of credits, all that should not exceed 40% of your household's gross monthly income. Gross monthly income is your salary before taxes. Before, like if your employer says you make 80,000, that's your gross income. Okay, so 40% of your gross income is the max that can go towards any monthly debt liabilities. And that goes with property taxes too, include property taxes, heat, those, and half condo fees. Like if you're going to buy a condo, and they charge you $400 in condo fees every month. 200 of that is towards this 40% ratio that I just spoke of. If you're carrying more than that, be aggressive about paying it down, so you're set up for success when you start your home ownership journey.
Great advice, Natalie.
Thank you.
Yeah. This is always a hot topic, Natalie, credit score.
Yes, yes. When I do seminars, I have multiple questions coming at me. Um, so, what's your credit score? Well, it's a three-digit number. Um, you can, sometimes I've seen where some financial institutions offer free credit scores, but I wouldn't rely on those because they're from a different source. What you can do, I found this get your free credit Equifax credit score. That QR code, if you search it, it'll bring you right to the Equifax website, and you can get your free credit report. I do this on an annual basis to make sure there's no mistakes. I want to know what my score is. I want to make sure everything's correct. But
So even if you're not getting a loan, you do it, right, Natalie? Like
oh yeah,
even you do it. Okay.
yeah, because it can affect a lot of things. And in the next slide, I'll talk about, why you want to do that. But when you're in fair, like 680 to 900, that's usually an okay range for lenders that will want to look at your application. When you're below average or poor, you are probably going to have to work on that to make sure it starts increasing. And that's where we can help as advisors to show you, okay, let's work on this. This could help with your score, because there's the debt to limit ratio. There's how many times you apply for credit. If you have collections, bankruptcy, consumer proposals, all those would bring down your score probably into the red category, if not the dark orange. But nothing is impossible to fix. You just have to have patience and work on it slowly.
Right.
So, what affects your credit score? Okay, well, that's a big question. Debt, of course. What you owe on your credit card, loan, mortgage, those all appear on your credit score. They show you when you got it, they show the payment, they show the limit or the original loan amount that you applied for, how many payments you've made, if it's ever been late. So that goes to payment history. Creditors like to see on-time payments of bills, right? So if you lent your money to somebody and then they never paid you on time, would you lend them money again? Probably not. So a lender looks at that in the same way. So again, if it's just the minimum that you can do that month, that's fine, as long as it's on time. How much available credit is in use, right? So that's the ratio between how much debt do I have over the limits that I have. So lenders like to see a lower debt to credit ratio, the amount of credit you're using compared to the total amount available to you, and how old are your credit accounts, right? If I just opened a credit card last month, I haven't proven that I can use that credit card responsibly. So a lot of lenders like to see 2 years of history. But even if you don't have 2 years, I'm not saying a lender wouldn't look at it. It's just 2 years shows consistent behavior around how people utilize their credit. Um, Number of new credit accounts open. Yes, so that's another one. So having too many new accounts may indicate to lenders and creditors that you're taking a lot of new debt and you might be a high risk borrower. So when I've pulled credit bureau reports on people that are applying for loans, lines of credits, and mortgages, and I see, 12 in the year, I kind of want to ask why. Why did that person ask for all these credit bureau report with different lenders? And sometimes I've seen it's just a car loan, right? Someone went to a car dealership. The car dealership went to all these lenders, and all the lenders did credit bureau reports. So a tip from me to you is if you do shop for a car or shop for something, and you want to ask, are you going to do a credit bureau check? Because if they are and they're going to multiple people, your score is going to decline a lot. Okay. One or two here and there, it's not a big deal, but just be mindful of that.
And we had a member ask a question around this, Natalie. So
Yeah.
you recommended the Equifax credit score to go and check what that is through on Equifax, and they're asking, is that going to impact when check your credit score? Is it going to impact your credit history, your credit score when you
Yeah. So,
check it?
so when there's two types of credit scores, like reports. One is called a hard pull, which means a lender is doing it. And that means there's a reason, there's a purpose why that credit report is being pulled. And then there's the soft pull, where you are asking for that credit report for yourself. So the reason is not to borrow, it's for you to check. So it would not affect your credit score. Also, like when we're opening up bank accounts for people, we do soft pulls so that they don't affect the credit bureau report. They just show the financial institution if that person is in good standing with their financial affairs. So those are two types of reports. So no, it won't affect you.
Perfect. Thanks, Natalie. So just got,
Um,
go
do
ahead.
you
No, that's it.
This one is mix of credit types. So credit types could be, credit card, a loan, a mortgage. It could be a leased car. All these are mixed credit types. And the thing with a credit card is it's revolving. It's called a revolving credit, which means if you pay it to down to zero balance, you can use it back up again. So lenders will look at a credit card as a possible debt in the future, right? Versus a loan, it's a fixed loan for a certain amount of time and it's going to end. So it does affect your credit score. I don't know by how much, so I can't comment on that one.
We did have another member, Jane, who's asking, is it wise maybe to look at the two different bureaus, both Equifax and TransUnion, to check your credit score? Like, I guess, Natalie, what's in your experience? Would there be differences potentially between the two?
They should be the same. However, some financial institutions, credit card companies, whoever you deal with, they might feed information to TransUnion and not to Equifax. I
Mhm.
don't see it often, but I do see it. And so when we're looking at applications, we usually look at both.
Okay.
But it's one report that's pulled on your name. Um, so hmm, you could check with TransUnion to see if they have a free one. I haven't checked. That's the only
Yeah.
thing I can say about that. But yes, you could check both because I remember when I was younger, I was applying for, I think it was a credit, no, it was a loan. And I found one of my family members' information on my credit bureau. So
Oh,
you can catch these things and correct them, right? Or maybe somebody with the same name as you, their credit report is on your credit report. So
mm,
these are good things to do, to check to make
like a
sure.
double check, right?
Yeah.
So how are we going to improve our credit score if we're in the, below 680, Natalie?
Yeah, so we mentioned this a couple times, pay your bills on time, because the credit bureau reports do track every single payment you make or you don't make. It's a tick against your score if you're past a 30-day late payment, and it gets worse on the 60-day, the 90-day, and then it gets into collections. So if you can do anything, just pay your bills on time. Um, Pay at least the minimum balance. I just mentioned that. And any extra funds help pay down high interest debt, right? So if you have a double pay, sometimes we get paid every 2 weeks, but we get two extra pays per year. You can pay down your debt that way, right? And manage your debt that way. We mentioned get a free copy of your credit bureau, for keeping an eye on your credit report. Also protects you against identity theft, fraud, and I mentioned that for inaccurate reporting. And then contact them, right? Contact TransUnion, Equifax, let them know what the discrepancies are and have them work with you to see, do you have to go back to the credit card company or the loan company for them to fix it? They'll guide you on how to do that. And other things to consider is consolidate your debts. Be wary of people who claim they can instantly fix your credit score, because if it seems too easy to be true, it's probably false, right?
Yep.
So be careful of people saying they're going to help you. I'd have my spidey senses up and say, I'm going to check this out first, and get your own sources to figure out who they are, what they're doing, because it's probably not true.
And then
And
Natalie, just wanted to mention, we also have, if you have credit card debt, you can always take advantage of a balance transfer at 0% to
yes,
help you, right? Pay that off,
yeah,
pay off your credit card debt without incurring additional, interest fees, right? So we do have a credit card that's got an offer that has a 0% balance transfer, right? So it's another good way to consolidate a high debt, right?
yeah. Thanks for mentioning that because that's a good promotion. And if you can save that much interest for a 12-month period, that's more money you can pay down your debt with.
Yeah. Yeah.
Um, the other thing too, I wanted to mention is like create a budget. A lot of people
Mhm.
don't have that structured, itemized to see visually what's coming in and what's going out. And when you do the exercise and you see what's really happening number wise, then you can make your informed decisions every month saying, okay, I can pay down X amount towards my debt. I can put a little bit aside for my down payment. I can, whatever goal you have, the budget is like the foundation of things. So if you need help with that, we can help you with that as well. And I think at the end there's a calculator link that can help you start something like that.
So we have some really great questions in the chat here, Natalie, in the Q&A. So I have one members asking, how's your credit score impacted by the use of their secured line of credit?
So a secured line of credit is a revolving debt, right? And it still follows the ratio. You should keep it at about 35% of the limit. But if you factor in all your credit cards and this line of credit and the overall utilization of your debt over your total limits, if all that is under 35% or under, your credit score should be good. Sometimes when people have a secured line of credit, it's also called a home equity line of credit. Um, you'll see that people use it for renovations or they'll use it to buy a car because the rate is really good. It's the lowest rate you
Mhm.
can get. And you might be close to the limit, but that's where you probably want to ask the lender. Maybe you can have a higher line of credit limit when you're applying for it so that it doesn't appear to be always maxed at like close to the limit. So I would just be mindful of that.
That's great. Thanks, Natalie.
You're welcome.
Talk a little about amortization now, changing gears.
Oh, yes. Okay. I actually did an exercise mathematically, so I'm going to keep it simple. But if you look at a 25-year versus 30-year amortization, 25-year amortization makes the most sense, right? Because when you want to save on interest and get the most competitive rate, it's the right amortization to choose. However, a 30-year amortization makes the most sense when you are most concerned about cash flow. Because if
Mhm.
you amortize it over 30 years, your payment's going to be smaller, right? So if you need that extra cash flow, because this is your first home, you might want to consider that 30-year amortization. Um, so it can help lower your mortgage payments. Yeah. However, choosing between 25 and 30-year amortization depends on your individual financial circumstances, right? Long-term goals as well, and comfort with monthly payment amounts. So when we walk you through a pre-approval, we'll say, okay, here are your options. This is 25, this is 30, this is a fixed rate versus a variable rate. We'll look at all that with you and then you see what works for you. And that's what we submit the application under, whatever is comfortable for you. So the government made 30-year amortizations available as of December 15th to all first-time home buyers as well as new construction purchases. Now, I did a comparison. If you had a mortgage for 500,000, okay, and you were paying like almost 4%, for 25 years, your payment would be 2,655. And for 35 years, it would be 2,231. So that's a difference of $424 more for the 25-year
Versus
amortization.
versus a 30
Okay.
year.
Yeah. But if you look at the interest that you're going to pay more under the 30-year, it's a difference of about 2,700.
Wow. Okay. That's good.
Right. So
Yep.
these are the things that we show you and show you the math, and then you can make that decision.
It's great. Yep. Okay. Down payments.
Yes, down payments. Okay, how much of down payment do you need? Well, it's 5 to 10% if you have a high ratio mortgage. So I'm going to explain the difference between a high ratio mortgage and a conventional mortgage. High ratio mortgage is when you put a down payment of less than 20% of the purchase price. Okay. So what happens in that scenario is that the credit union or bank uses a company that insures these kind of mortgages. Most people are familiar with CMHC, Canada Mortgage Housing Corporation, but there's also Sagen, and I believe there's a third company. They all offer the same high ratio insurance. And it's to guarantee them that mortgage for the lender. Okay. They charge a premium to do that, but it gets added to the mortgage. So you don't have to pay it out of pocket, but you're going to pay it in your payment every month. Um, and honestly, it's a great way for someone to get into the home buying market with as little as 5% down. Okay. A conventional mortgage is any time someone puts more than 20% down payment on the purchase price. Okay. So the credit union approves the mortgage themselves, whereas the high ratio the credit union or bank has to approve it, and so does CMHC or Sagen. Whereas the conventional is just the financial institution approving that financing for you.
Great.
Next slide explains this high ratio. So purchase price, 500,000, less than 500, you only have to put 5% down. But as you can see, if it's between 5 and 500,000 and 1.5 million, the first 500,000 is 5%, and then the remainder is a 10% down payment. So that can add up pretty quickly. And if it's anything above 1.5 million, you need a 20% down payment. Ouch.
Yeah, it's a
Yeah,
lot.
yeah.
For sure. Okay. You mentioned like mortgage insurance for the high ratio, Natalie. Tell us a little about that.
I'm not going to speak too much about this, but what mortgage default insurance does is it protects the lender, right? In the 1980s, I don't know if you heard stories where the rates, the 5-year fixed rate was 21.75%. Okay. So if someone had a mortgage at that time and they couldn't afford it, they would bring back the keys to the bank and say, "I'm sorry, I can't afford my mortgage." The home would be sold. Maybe it didn't get sold at a profit, so there would be a loss. And this mortgage default insurance would have paid the lender the difference so that they wouldn't go back on the homeowner for that
Mhm.
money that they lost, right? So it may protect the lender, but it also protects the borrower so that they're not held accountable to pay any difference if something happens. Because life happens, we don't know what can happen,
Mhm.
health, loss of a job. There's so many things, right? And so default insurance is there to protect us as lenders and you as the borrower.
Okay,
That's all I
great.
have
Yeah, that's
for that
great.
one. Unless
Well,
there's
no, that's it. We're going to take a little break and we're going to do another short poll. Again, it's anonymous, so please just answer. And the questions on a scale of 1 to 5. 5 is the most important. How important are the following points when choosing a mortgage lender to you, right? Is it the lowest interest rate? Is it the lowest monthly payment? Is it the best customer service? Or the lowest closing cost? So what are you looking at when you're choosing a lender? And I'm sure it's probably a mix of these things. So just feel free to answer the best you can. So we know for sure the everybody's looking for a good interest rate, right? Because as Natalie said, this is the largest investment you're probably ever going to make in your lifetime. So, hands down, the rate is definitely important, but it looks like people are also valuing customer service and looking at their monthly payments. So it seems like it's lowest interest rate followed by customer service, and then low closing costs and the lowest monthly payment. So just going to give it just a few seconds here, but it seems like now everybody's answered. So, oh, they're still answering. Okay. We still got some people answering. Okay. If you wanted to maybe just show that on the screen so everybody can see. So definitely it's lowest interest rate followed by the best customer service. So those are the two. And that makes sense, right, Natalie? We all need to keep our costs down and we also want to have good service and good advice, right?
absolutely,
Okay,
yeah.
thanks. Yeah,
And for
for
the
sure. Yeah,
customer
go ahead.
service, I would add for customer service, people don't realize after everything's done, after you've moved in, you still need that service,
Mhm.
right? you need advice how to pay that down faster, or maybe there's a problem with you wanting to pay extra, or there's an issue where you wanted a certain rate, or you want to transfer from a variable rate to a fixed rate. These are all service related things, and you want to be with someone who's there for you at every moment.
Okay, we're going to move on to talk a little about how to start saving for your down payment.
Yeah. So I'm going to repeat myself. It's a budget. For
Mhm.
me, that's the first foundation. So you can decide what you'd like to put aside every month towards savings for your dream home. So once you know your numbers, and sometimes you have to revisit it every 6 months. Maybe you got a pay raise. Maybe your expenses went up. Maybe, there's so many
You
variables
got
in
an
a budget.
inheritance, who knows, right? It's always
Yeah.
possible.
Or, someone wants to gift you a down payment, then you have to save less, or maybe you want to redirect that savings for other things. Um, and the easiest way to save, obviously, is automate your savings. You can set up pre-authorized contributions from your paychecks. You can do that online yourself. I do it myself when I want to save. I have goals. I say, okay, send this to that account, send this to that account, pay my whatever bill automatically, and then it's set and it's done. And every so
Nothing, you don't
often,
have to think about it.
exactly. Yeah. Use your refunds and bonuses. Absolutely. If you do RSP contributions, you get a tax refund. Use it for good instead of spending it, because it's really easy to spend money. We all know
Mhm.
this. And so if you can think about it and say, okay, this is going to go towards my goal, or maybe some of it. And the last thing is FHSA is first home savings account. So that's a new plan, newish plan. It allows you, if you're a first time home buyer, sorry for everybody else, but it's only for first time home buyers, to save, to buy, or build a qualifying first home tax free up to certain limits. So you have to be 18 years, and you did not live in a qualifying home as your principal place of residence, and you owned or jointly owned in this calendar year or in the previous 4 calendar years. The annual maximum is $8,000. The total lifetime contribution is 40,000. Okay. And contributions are, get this, tax deductible. So they're like an RSP, where they deduct against your income, you get a tax return. Use that towards your savings as well for your down payment.
Great.
The
Yep.
HBP program is it's short for Home Buyers Plan. So it's your RSPs, right? It's a program that allows you to withdraw from your RSPs to buy or build a qualifying home. The government increased that amount to withdrawals of up to 60,000 last year. So if you're purchasing a home with a partner, each of you can withdraw $60,000 for your down payment, or whatever housing related costs you have when you're buying that home. The program allows you to pay back the amount withdrawal within a 15-year period. So the FHSA is not like that, but the HBP program is. So if you withdrew 60,000 from your RSPs, you'd have to repay $4,000 a year. That's $334 a month. And if you don't, you're going to pay tax on that 4,000 every year that you don't repay. That's how it works. TFSA allows you to withdraw money tax free. It's a great plan. I love TFSAs. This year's contribution room is 7,000. And if you were 18 years of age in 2009, you have room of up to 109,000 minus all your other contributions.
So it's cumulative. If you missed a year, you can make it up.
Exactly. Yeah.
Perfect.
And I always say, to learn more about this, sit down with an advisor. We'll be happy to
Perfect.
help you. Yeah.
So pre-approvals.
Yes. Okay, so pre-approvals, credit score. We're looking for lenders often use credit scores to assess the risk. Higher credit score generally increases your chances of mortgage approval. Your income and employment. Lenders want to ensure that you have a stable income to make monthly mortgage payments. They may verify your employment history and income stability. So I talked about that. They want to see consistency, right? That what you're making now could go on for years to come. Debt to income ratio. So lenders calculate, that 40% I was talking about. So debt to income shouldn't be more than 40%. And it shouldn't be more than 32% for housing. So mortgage, half condo fees, taxes, and heat shouldn't be more than 32% of your gross income. Down payment, the amount of money you can put down as a down payment can affect your eligibility. Larger down payment results in a better loan terms and may make you a more attractive borrower for sure. Loan to value, so that is the ratio it compares the loan amount to the appraised value of the property, right? So lenders may have specific loan to value requirements depending on the property. Like there's some really weird properties out there, and they might have certain, maximums that they'll allow. And employment history, right? Consistent employment, stable job history can positively impact your mortgage eligibility. Also, if you're in a separation, we're going to ask for a separation agreement, or because we want to see what the child support might be, what the spousal support, or none. Maybe there's nothing, but we still need to confirm that. So if you don't have a separation agreement yet, that's a key document that you need to work on,
I
unfortunately.
didn't even think of that. That's a great tip for sure.
Yeah.
Anything else in the pre-approval? That's it?
Yeah,
It's
I
quite a
think so.
bit.
Let me double.
And
Yeah.
is a pre-approval guarantee, Natalie, right? So once you get your pre-approval, am I good to go?
Mm. Well, I would say no.
Yeah,
A mortgage pre-approval doesn't guarantee you a loan. It's just one step towards the approval, right? It will determine how much you can spend on a home based on your finances and the lender guidelines, right? Your pre-approval also provides the interest rate as a result of your projected monthly mortgage payments. At Alterna, our pre-approval is guaranteed for 120 days. So if you make an offer on a home during that time and interest rates go up, your rate won't increase because you're guaranteed for 120 days, right? But if they drop, you get the lower
the
rate.
best of both.
Exactly. So you can't lose, right? But when you
Yeah,
find that home, that's when the official approval starts happening. Okay?
great. Okay. And then
Because
just, the variable versus fixed and, high level, Natalie. You
yeah, I'm not going to talk too
Yeah,
much about this. It's really about your risk tolerance. That's what
right.
I when sitting with somebody is, do you want to watch the rates? Well, that's a variable rate. If you don't want to watch rates and be set for a little while, it's a fixed rate.
But also it's like comfort, right? If you're not the type of person that likes, to your point, risk, like you want to know what your payments are every month, then it's the fix. You don't want to have to worry, right? If the rates
Absolutely.
are going to go up, right? So that's
Absolutely.
really the key here, right?
Yeah.
Okay. And then this is the 8-step, the guide.
Hmm.
Take us through this.
So, planning costs, yeah. So when you sit with your advisor or yourself, you want to figure it out. That's the budgeting, planning the costs, figuring that out. You get yourself a pre-approval, so you get some document that says, "Oh, I can afford this much mortgage. This is my purchase price because I'm telling them I have this much down payment." Finding professionals, so your real estate agent, your home inspector. There could be other professionals. Right now, it's lawyer, home
Mhm.
inspector, and real estate agent. You want to make an offer if you find something, but you also want to put a financing condition, right?
Right.
Sometimes the seller does not want a financing condition, but it allows you a week to go to the lender and say, okay, can I get this house, this particular house, right? An appraisal done, it's all done in
Mhm.
that 1 week period. And it allows you also to do the inspection during
Home
that 1 week
inspection.
period,
Yeah.
right? And then if everything gets accepted, you accept the offer and the conditions are finalized, then the mortgage is finalized. You sign the documents closer to closing, usually about 2 weeks prior to closing with your lawyer, with the bank, with the credit union, and then you move in.
Which is the best part.
It's just
Yeah.
the beginning.
Yeah. 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 So, this really just talks about alternative. And you've mentioned a lot of the things here already, Natalie, right? Our competitive
Yeah.
rates, that 120-day rate guarantee, which is nice, up
Mhm.
to $1,000. Fee coverage when you do a sign on, the flexible payment options, the prepayment flexibility, which is important, right? You
Yeah.
can pay up to 20% of your principal annually, which is a nice little bonus if you have the money to pay down your
Of your
mortgage.
original amount.
Of your original amount, yes, of
Yeah.
your original amount, right?
Yeah. Yeah.
And
And
no
you can
hidden
double your
fees.
payments, you can
Yeah,
increase your payment, all
yeah,
that is in the 20%.
flexibility. Yeah,
Yeah.
which is great. So we just wanted to let you know about that. And then we wanted to give you a few of the tools. There's the QR codes here. We are going to send these out to you as well. So if you weren't able to stay till the end. So we do have some calculators on our website. If you click the QR code, it'll bring you right to the calculator. There's a mortgage affordability calculator, which you can play around with. It will show your monthly payments with an interest rate. So you can, as Natalie said, you got to make that budget. You have to see how much you can afford, right? And then there's also a mortgage prepayment calculator. And then we have a number of articles on the site. If you just alterna.ca/blog, or the QR code will get you there on home buying. So and it's for new home buyers, it's for people that already have a home or downsizing, all types of articles. And Natalie keeps mentioning budget, 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 which is so important. So you could go to again alterna.ca/budget dash planner, and we've got a budget planner there for you. Okay, but we will send this out. So I want to close here. I know that we're a bit over time and we didn't get to all of the questions. However, we will actually respond to your questions in the email. So some of them are anonymous. So what I would do is we'll send you an email, a follow-up email, either tomorrow or the next day, and we will answer your questions, right? So I do want to get to them. So we just ran out of time. So apologies for that. And I do want to thank Natalie so much for all her great advice and tips, right? So, and thank everybody that joined online. I hope that it was
Yes,
informative
thank you.
for you. Yeah, thanks, Natalie. And so just we are going to send you that email with the answers to the question. They will also have a link to the webinar if you want to go back and relook at anything. So you'll have the link to the webinar, and there will be a survey, short survey of 5 questions. We just would like to know if you felt the webinar was valuable, if you'd like to see other topics. So that would be helpful if you could just quickly respond to that. So again, thank you, everybody. Thanks again. Special thanks to Natalie for joining us today on the Home Buying Webinar. Have a good day, everybody. Bye-bye.
Everyone.